What I always encourage founders to think about is not your competitive landscape exactly, but your customers' perceived alternatives to your product. If you're bringing a product to market and it's exactly the same as the idea that you started with at the very, very beginning, you've almost certainly done something wrong.
Co-founder of Twig Ventures, angel investing group for sustainable fashion tech startups in the US. Welcome, Levi Reed.
The number one question I get right off the bat is founders asking me to evaluate their idea, right, in whatever shape or form. And what I always say is that I can't do that. I can't tell you if your idea is good or if it's promising, and neither can anyone else, frankly, with one exception, and that is your potential customer. And so what you really need to do, whether you're a first-time founder or a 10-time founder, is right off the bat, you start having conversations with your potential customers. And there's a particular type of structure to those conversations. You don't want to present your idea and say, oh, would you buy this, right? Because people generally say yes. What you want to do, you're investigating their subjective experience and their pain point around the problem that you're trying to solve. So what you're trying to understand is, have you identified a real pain point? Is this actually a problem for your customer group? Is it frequently a problem? Is it a challenging or difficult problem? Is it something that they would pay money to solve, right? And then what you're trying to do is extrapolate from what you learned from that customer. Does your idea actually solve their problem in a way that's meaningful, right? And there's actually some pretty good research and statistics behind this. It's not just my opinion, but one of the biggest areas of failure for early stage startups, the different causes can usually be traced back to not doing sufficient customer research or doing customer research that yielded results that are not representative of what's actually going on. Really understanding subjectively from your customer's point of view, what is this problem? How severe is this problem? And then, like I said, extrapolating. And when I say extrapolating, because you really want to avoid, especially at the early stage when you don't have a product and you're talking about hypotheticals, you want to avoid a situation where you find yourself saying something like, okay, but if I could solve that problem for you, how much money would you pay for it, right? It doesn't matter what answer you get to a question like that. It's too hypothetical. The answer is effectively useless. And so what I always tell founders is it's your customer's job to tell you what the problem is that they're suffering, right? And all the shape of that problem. How frequent is it? How big is it? How much of a problem is it? It's your job as the founder to take what you learned from the customer, connect it to what you know about your idea, and make a decision about whether or not your idea actually solves their problem and whether that problem is worth solving. In the sense that, if you're talking to people and you're saying, oh, how often do you experience this problem? They say, oh, I experience it all the time. You say, well, what do you do about it? And they go, well, nothing really. That's probably not a problem worth solving, right? If they're saying it's a problem, but they're not actually doing anything about it, it's not really a compelling problem. What you're looking for is a situation where somebody says, yeah, I deal with this problem all the time, and to solve it, I have to take 3 hours and use all these different tools and figure this out. And it's just such a headache. And God, I wish somebody would just make a thing that did X, Y, Z, right? And if your solution aligns with that, now you're looking at what a brilliant product manager friend of mine calls a hair on fire problem. That's what you're really looking for as a founder. A big deal where you're looking at it and you're going, how on earth has nobody solved for this yet? Right? When you start having that moment. But even then, right, pump the brakes, be cautious. I've seen a lot of founders get really excited because they have a couple conversations with people who are just pulling their hair out over some big problem. You still need to validate. You still need to understand, right? You still need to understand, is it a costly problem? Right? Is it a frequent problem? Is it something that really requires solving? And again, does your solution actually solve it? That's a great question. I would say, at a high level, it depends on the type of problem you're solving and how many customers you'll need, right? If you're selling a low ASP, B2C product, you probably want to talk to more customers within your target group. If you're selling a very, very high average order value or high margin product, software product to large enterprise, you're probably going to have a much more narrow and specific buyer persona that you're talking to. But in general, I mean, really rough ballpark, you should be measuring in numbers that are like 50 to 100, in my opinion. But this is an iterative and ongoing process. So I'm not saying you need to go talk to 100 people before you get started. You talk to a few dozen, you're starting to see indicators. Great. Let's get started on maybe building out an MVP, creating something that can be tested, a Figma model, right? Whatever it is that kind of works with your idea. And along the way, you're continuing to talk to those customers and continuing to iterate, because you're going to pivot too. And the thing to remember about the pivot is, so on average, before raising real capital, right, like Series A, Series B rounds, successful startups are going to have 2 meaningful pivots on average, right? those pivots don't necessarily need to just be in the product. They might be, right? Slack being like a famous example, right? This is a company that started to make a video game, had a distributed team, thought that they would have a chat app because there was nothing really good to enable them to work. Video game totally flopped. Nobody remembers it anymore, but people love the chat app so much they turned around and took this tool they built internally, made that their product, and boom. The wild thing is they're not the only one. Discord actually has the same origin story, exact same failed video game to chat app. But anyway, you're going to have these pivots, but the pivots aren't always going to be so dramatic in the product. Sometimes the pivot is going to be what customer you're serving, what problem you're solving, possibly even with the same product, right? Or maybe even more subtle than that, how you're positioning your product, right? Because one of the things that's really important to understand from those customer interviews as you progress in the stages of building your product is you're going to start moving your conversation from what is your problem and am I solving it to how are you comparing my solution against whatever else is available in the market, right? Because a founder is always going to have an idea of the problem they're solving and who their competition is. But what I always encourage founders to think about is not your competitive landscape exactly, but your customers' perceived alternatives to your product, right? Because their perceived alternatives to your product may be very different from what you're thinking about. Let's say you open a cafe, right? You're selling coffee. So you go, well, clearly my competition is Starbucks, right? Maybe. But if your customer is looking at your product as a way to get caffeine in their body quickly, maybe your competition is energy drinks or, caffeinated gummies or caffeine pills. Or maybe your customer is looking at your product as an enjoyable, relatively low cost indulgence, in which case maybe you're competing against things like donuts and pastries. So as you pivot, as you move, as you progress, let's say you're, taking this silly example, right? You've launched your cafe, you have a product in the market, you're selling to customers. That doesn't mean you stop the customer interviews, right? You're still talking to the customer. But now, instead of asking about this pain point, you're asking about their emotional relationship with your product and what they see as an alternative to your product, right? And so you're asking questions around, like maybe it's as simple as saying, if you couldn't get my product, what would you get instead? Right. And if the person says, well, I go to Starbucks, okay, then maybe coffee is. But if they say, oh, well, I just get an energy drink or I eat a caffeinated gummy or I'd go get a donut. These are all very different things, right? So it's really important to realize that any product, any service, any product sits at a nexus of different pain points that it might be solving for your customer. And depending on how it's solving that pain point and what the perception of that pain point is by the customer, you're going to be compared against different alternatives, right? And what is seen as a strength versus a weakness of your product is going to vary greatly depending on what alternatives you're being compared against, right? Like to take this example, if you're a small indulgence, right, then the larger size of a drink and the more bells and whistles you have are going to be seen as an advantage. If you're seen as an efficient way of getting caffeine into someone's body, then the more bells and whistles and volume to your product, more of a disadvantage probably, because it's getting in the way of all that caffeine, right? So really important to understand what is your customer's relationship with your product beyond the pain point that you're solving, the core problem. What are the jobs to be done by your product, right? What are the boxes that need to be checked for your customer to be satisfied with it? And associated with that, what are they positioning you against? What are they seeing as the alternative to your product? And you want to start to understand that more as you're refining your positioning going forward. And so, as you learn more about that dynamic of your relationship with your customers, your potential pivots might move away from product features and might start moving towards messaging and positioning and be much more of a marketing play. Maybe, right? There's no guarantee, but it's really important to keep that in mind because it's much, much easier typically to make a shift in your positioning or your messaging or even your customer targeting than it is to your product itself. So you kind of want to rule out those possibilities. If you decide you need to pivot, you want to rule out those possibilities before you start going back to the drawing board and saying, hey, we need to make major changes to the product, right? But a lot of founders, especially more technical founders, they go to product immediately. It's not solving the problem. The product's not good enough. And a lot of founders, I think, still buy into this myth. And let me be very clear, this is a myth, that if you build a good enough product, you don't need to do marketing, right? Not true. There are exceptions. Of course, there's exceptions to everything. But in general, that's a dangerous path to walk as a founder. I think it is absolutely critical. I think it's one of the number one most important things that a founder needs to do. And unfortunately, it's one of the number one least favorite things for most founders I talk to, right? Because it is a lot of work. And it's also, look, not to buy into stereotypes here, but some of them have some validity. A lot of technical founders, they want to go build stuff. They don't want to go talk to people, right? The whole reason they're leaving a large company is because they don't like having to talk to people. They want to just build cool stuff. I have so much empathy for that. But if you're building a business, You're building a thing and you're building a relationship with a whole bunch of people who need that thing. And that relationship part, that's absolutely essential. You can't get away from it. Now, if you have the resources or the co-founder who can do it, maybe you can delegate that responsibility. But someone at a very fundamental level of the company, at a very senior level, as in like a founder level, needs to be doing this research from day one. And there needs to be a really good process for making sure that everybody building within the company is aware of the outcome of this research and is incorporating it into their work on a day by day, hour by hour, minute by minute basis. It needs to be integral to the company. I'm not saying it's the only path to success, but it's if you don't have a good process for customer interview and you succeed, you're succeeding by chance. Essentially, it's just random chance at that point. I'm very skeptical of surveys, to be honest. There's so much room for ambiguity, and good survey design is deceptively difficult, like really difficult. So my usual recommendation is either to avoid surveys entirely or to use them as feeders for customer interviews. So the survey is really just an initial filtering mechanism to try and get people in for customer interviews. But ultimately, in my opinion, the gold standard is face-to-face one-on-one interviews. Unless you've got an extensive background in market research techniques, I wouldn't touch focus groups with a 10-foot pole. Way too many problems there. Even established like marketing groups that used to make that kind of research, their bread and butter, are typically moving away from focus groups. You can do some online research. There are tools for that kind of thing, but in general, I would focus everything on trying to get more customer interviews. And then one of the big questions that always comes up when I say this to founders is, oh, but it's so much work, right, with the cold outreach, blah blah blah. Yes, understood. But your goal in conducting the customer interviews is to get away from cold outreach as quickly as possible. And one of the simplest, easiest ways to do that, frankly, is just if you've had a good interview with someone, tell them what you're looking for and ask them if they can recommend anyone else, right? If you're talking with a specific persona of someone, especially for like a B2B product where you're talking to a particular like job function, I mean, there's a decent chance that person is reasonably well networked within that job function, right? So you're talking to procurement people at a particular type of software company, decent chance they know other procurement people at similar software companies and might be open to making a warm introduction for you. One of the big things to be important about is in that outreach is just be really clear about what specifically you're asking for, that you're not selling anything, and what the commitment is that you're requesting. So, I'm doing this informational interview. I'm not selling you anything. I'm asking for 30 minutes of your time, and I want to ask you about your experience with this type of software, right? And then I, as the recipient, can look at that and go, oh, okay, I do in fact meet that profile. I can answer those questions. You're asking for 30 minutes of my time. I can make that. That's 30 minutes I can spare. That's not a problem. And you're promising not to sell me anything. If you don't include that information, I'm going to read that note and go, either this is a really sneaky sales pitch, so absolutely not, or you're not being clear about what you're asking. And now I'm scared to respond, because it's like when you're the only guy in your friend group with a pickup truck and somebody says, hey, are you free this weekend? You're like, no, I'm not helping you move, right? But if you come right up front and say, all I'm asking for is a 20-minute call to ask you about this thing, then I can say, oh, okay, I can time box that. That's doable. But I don't want to open myself up to a request that I'm not willing to field and then have to awkwardly back out of it. Oh, interesting question. Well, on the most end of the spectrum, the more that you're building genuinely new science and technology, the lower on the technology readiness level, that one's called TRL, the lower you are, the more expensive things are going to be, right? Pharma and biotech, typically very, very expensive, all or nothing plays. It's not uncommon to see in pharma startups, reach multi-billion-dollar valuations without having a product on the market. And the entire time, it's usually a really binary value proposition, right? At the end of 10 years, they either get approved for some new medication and they make just boatloads of money, or they don't get approved and all of that value goes to nil, like overnight, right? And they're worth nothing more than the value of their lab equipment. So that can be really dramatic. That's not a space I really play in because I'm just not experienced enough to make good risk assessments in that industry. On the less capital intensive line or end of the spectrum, I'd say simple software is probably some of the lowest lift, to the extent that I would actually say, and I suspect we're going to see a lot more of this over the next few years. It's getting easier and easier for someone with some tech skills or the ability to learn those skills, and it's frankly never been easier to learn those skills, to spin up, a simple app, a simple piece of software, a plugin for an existing platform like a Slack plugin or a Shopify app, and potentially, create a revenue stream or possibly even a composite revenue stream out of a few of these different products. It might not be venture scale, but it often can be enough to be a pretty decent source of income for a founder, potentially even life-changing income if they really are successful. But, a company making a few $100,000 or $1 million or even a couple million a year with, 1, 2, 3, 4 employees, that's decent money for all those folks. And often, they might have to do a few hours a week of work to keep that up and running. It's nothing that a VC is going to look at. So you don't hear about it, right? But I think it's really important to understand as a founder, especially if you're thinking about the financials, that there's at one end of the spectrum, there's a failure. My camera's not quite here. There we go. At one end of the spectrum, there's a failure for the founder and a failure for the VC, right? You don't make enough money, it's not going to go. At another end of the spectrum, you're making billions of dollars, whatever. It's a success for the founder, a success for the VC. But there's a huge gray zone in the middle that's really, it ranges from not bad to life-changing for the founder. That's still a failure for the VC, right? And I think it's really important that founders understand how that VC math works and really have a very thoughtful review of the pros and cons of accepting equity-based funding before they go seek it. It is far from the only way to build a business. If they put any capital in, which many founders have, they're going to lose that. They're going to lose a lot of time and the effort that they put in. So that's going to be the big part for a lot of founders. It's an emotional hit. It's a founder's baby. Typically, there's a lot that they put into it, and what any founder will discover is that early on, the self-doubt can be crippling as you're trying to build. You don't know what you're doing. You're going to feel like you don't know what you're doing. You're trying to convince other people you know what you're doing so they can give you money when you don't know what you're doing, right? That's very, very challenging. And then if you get to a point where you're clearly struggling to find success and it's really difficult and you're in that place for a few months or maybe even a year or two before you ultimately fail, that's psychologically and emotionally devastating. And if you're not careful with your funding and you've been putting money into the company, you could come out of that totally burnt out and with your finances depleted. And now you got to go try and find a job after hitting what might be the biggest professional failure of your life. And it's going to feel like a personal failure too. I think it's important to be realistic about the emotional and psychological hit of enduring, a startup failure like that. Doesn't mean you shouldn't do it. It does mean that you should go in, clear-eyed about it. And it also means that to whatever extent possible, you should be thinking as a founder about your emotional health and well-being and stabilizing it. As an investor, that's something that's very important to me. I've just had that call with 2 founders I'm working with earlier today. Just how important it is to take some time, take a break. Remember that, and I will say investors have different perspectives here. There is a very much an investor perspective that's burn the boats. I want you fully committed. This should be your absolute livelihood and you should be devastated if it fails. Fine. That is not my perspective at all. I believe that the best founders are founders who can hold things in an appropriate perspective, who can approach building a company from a position of emotional stability, who will be, yes, upset if it fails, but not utterly devastated, hopefully, who have other things going on in their lives. I personally feel that this is just much healthier and better balanced, and I think you see better outcomes. That's my opinion. But either way, from a founder point of view, take care of yourself, take care of your emotional health. The challenge is very real. It's a really good question. I don't really care about the idea, to be honest with you. Ideas are mostly worthless. And I think this is something that a lot of founders kind of struggle to wrap their head around. Tons of people have ideas, right? Ideas come and go. The idea that you go to market with and you start building with, the thing that inspires you to get started, is almost always going to be substantially different from what you ultimately find success with, if you find success, right? Those 2 pivots I mentioned. In fact, I would go so far as to say, is this a common refrain in startup land? And I fully and wholeheartedly agree with it. If you're, a year on or something and you're bringing a product to market and it's exactly the same as the idea that you started with at the very, very beginning, you've almost certainly done something wrong. So for that end, the idea matters insofar as it's something that makes sense, that hangs together logically, that indicates that the founder has an interesting and novel perspective on the space that they're trying to address. It shows the direction that they're hoping to go in. Much more than the idea itself, though, I'm really interested when I talk to a founder in what have they done to validate the idea and what have they found. That to me is much more interesting, right? Then the idea starts to become worth something. As you start to put some work into it, then it starts to become worth something. But all along, what I'm looking at is really, at this point, the only impetus behind it is the founder or the founding team, right? So how are they thinking about this? Where did the idea come from? How are they stress testing it? How are they evaluating it? What are their plans to go forward, and do they make sense? What competencies do they have? What competencies do they lack that they're going to need? And are they being open and honest about the competencies that they lack? What's their plan for getting those competencies, right? Are they bringing on another co-founder? Are they hiring? How receptive are they to criticism and feedback? And to be clear, that doesn't mean that they accept anything. If I'm their investor and I say, oh, I think you should do X, Y, Z, that doesn't mean that they go, okay, we're going to go do X, Y, Z. That means that they look at it and they go, we're going to do X, we don't agree with Y, and here's why, and we're going to kind of do Z, but we're going to modify it, right? That, to me, that's taking advice well, right? If a founder is doing everything I say without question, we have a problem. They should not be doing that. They're the founder, they're the expert. I'm an advisor. I don't know jack, right? Like, you should not be listening to me unquestionably, ever, or anyone else for that matter. You should always be passing it through the filter of your own experience, your own perspective. I say to founders all the time, it's your company and you have to live with the consequences, right? I don't have skin in the game. I mean, maybe I do if I'm a direct investor, but even then, I don't have as much of a connection as the founder does, right? It's much easier for me to say things. So I'm always going to try and be responsible, but I'm not the boots on the ground. They are, right? So those are the things I'm looking for. Because, at the end of the day, the idea may change. They're going to pivot. All that's going to happen. The only thing that I can know more or less for sure that's going to be constant is the founder, right? So ultimately, I'm investing in the founder because that's what's in it for the long haul, not the idea. They absolutely must have curiosity and have the skill of learning new skills. That's one of very few things I would say is non-negotiable for me. Beyond that, I like to see kindness. I like to see compassion. I like to see some empathy. I like to see, something that pulls them more than just money, that they're looking at the world and they're saying there's a thing not in it that needs to be in it, right? That's a quality that I'm really looking for. But at the end of the day, what the most important thing, number one thing, ability to learn and the curiosity to drive them. Oh man, that's a really good question. I don't have a good answer to that question. I don't think anybody else does, but I think asking the question is really important. So I think the best thing that I can do here is say that, in my opinion, a good way to approach this is if you're in that liminal space where you're going, oh, I don't know if this is going to be successful. You're starting to think about throwing in the towel. My advice, and by the way, my advice here is the same for people who are contemplating leaving a job if they don't get that promotion, right? For people who are, working on a particular project that doesn't seem to be going anywhere and trying to decide if they want to pivot away from it, any of these cases. When you look at it from an incremental basis, right? If you're saying, oh, I didn't get the promotion this time, but they're telling me next quarter, or, this thing didn't work out, or I didn't get that funding, but maybe this next thing next week, right? You can always argue yourself into going just a little bit further, right? There's an old thought experiment used for a totally different purpose, but I'll repurpose it here. That, if you're driving down the interstate, the speed limit's 60 miles an hour, you probably go 2 miles an hour over, right? It's not really going to make any difference in terms of safety. Nobody's realistically going to pull you over for that. 1 or 2 miles an hour isn't going to make any difference. Well, maybe you go 1 mile more than that, right? If somebody's going to not pull you over for 62 miles an hour, they're probably not going to pull you over for 63 miles an hour, right? But if we make a jump and suddenly you're going 80 miles an hour, you're definitely in trouble. That's a huge increment, right? But at no point is 1 mile an hour really like, where's that threshold? It's in there somewhere, right? But it's really hard to pin down at one specific point. And I think it's the same problem here. When we're looking in tiny increments, really hard to draw a line. So my advice is look ahead, whatever time frame makes sense for your situation, weeks, months, whatever, and give yourself a red line, right? 3 months out, if this thing has not happened, if I haven't hit this threshold, if I haven't raised this capital, unless there's X mitigating circumstance, maybe whatever, then that's going to be my signal. If we cross that line, time to wrap it up, right? And I think ultimately that's really the best answer that I can give, because there is no one size fits all answer to this question, but it is important to be realistic. And for the record, I actually have a whole blog post / rant about this. I really, really dislike this pop culture, idea of grit and never give up. And I did it, and that means you can do it. No, we're talking about a game of probabilities here, where success is by far the less likely outcome, right? Like, let's be honest about it. Somebody else being successful is not indicative that you too can succeed if you only never give up. That's how people destroy their lives. Don't do that, right? Be thoughtful, be rational about it. If it's not working out, that's okay, right? Cut it off, draw the line. Don't buy into the sunk cost fallacy. Pull back while you still have resources. Try again. Don't burn it all in one thing. I am so against this idea of, the burning the ships, so there's no ability to make a what do you call it? No recourse, no ability to backtrack. I don't agree with that at all. But at the end of the day, you can encounter existential problems at every phase of a company's development, right? And so I don't think I would push back and say I wouldn't assign a time value to it. I would look for specific factors, right? Signs that you're not achieving product market fit, that you're not competing effectively in the existing current landscape, that your technology has not kept pace with innovation, right? These are the kinds of things I would be looking at regardless of what, time, at what point in time you are in the company's development. Yeah. I mean, it's like a joke in MBA programs, right? That the correct answer to every question in business is it depends, but it's also kind of true. Well, if we're talking about investing in startups, the challenge here is going to be that you do have accreditation rules in the U.S. and most other countries that require a certain amount of income and or net worth to be legally permitted to invest. There are loopholes here. If you have the capacity, you can go for like a series, 63, I think, certification in the U.S. And then I know there's some other loopholes around like having a direct personal relationship with the founder, something along these lines. Setting that aside, I think if you're just looking at trying to build kind of a track record as an investor, there's different types of programs. For example, here in Seattle, we have a really wonderful organization called the Seattle Angel Conference that's sort of like an accelerator for angel investors. And one of the really cool things that they do is they have they call a proxy program, where a non-accredited investor can come in and an accredited investor can basically say, I want to participate, but I don't want to be active. I'm just going to put up the capital. And then the proxy, the non-accredited investor, comes in. It's not their money. They're not making the direct investment, but they have the opportunity to act as an investor and make a decision and allocate the capital, which means that now they can turn around and say, hey, yes, it wasn't my money, but I reviewed the due diligence. I investigated the company. I made this investment. Here's how the investment is performing. Similarly, a lot of different VC funds, and this is increasing now, particularly funds focused around supporting underrepresented founders and underrepresented investors, are offering different types of programs. Usually they're called a Deal Scout program, but there's other terminology used. And effectively what they'll do is they'll allow someone with subject matter expertise and or unusual exposure to companies in a particular vertical or to startups to make recommendations for investment to the fund. And then typically the way the arrangement works is if the fund makes an investment in a company that you as a Deal Scout recommend, you get a small slice of the carry, the return on that investment, if and when it liquidates. Typically those programs are less for finance. I mean, obviously if you pick a big winner and you get carry, awesome, you make some money out of it. But the goal really is to help you, again, build a sort of synthetic portfolio as an investor. And then on a similar level, if you're able to find work, usually it's in the context of a job, a full-time job or a part-time job with, say, an accelerator or incubator program. Often a component of your compensation may be exposure to some equity from some of those companies. And so that can be a way to start to build a portfolio as well. Outside of that, working for startups, you're typically going to get equity that way. Although the thing to note is that if you get equity from a pre-IPO startup as an employee, it's usually going to come in the form of options, not restricted stock units, RSUs. And so what that's going to mean is that those options are essentially a right to purchase stock at a specific price. And that specific price is typically going to be much, much lower than the market value, but it's still a capital outlay. So if you get 10,000 shares and it's $1 a share, great, but that's still $10,000 to go buy those shares, right? And so typically what you're going to do in that case is you're going to hold those options as long as you can without exercising to maintain the option value. But usually the standard is that if you leave the company for any reason, you typically only have 90 days to exercise the options for they expire. So that can be quite challenging because then you have to make a decision. Do you want to spend thousands of dollars on stock that may or may not be worth anything? Or do you want to let your number one biggest, financial return opportunity from working in that startup lapse and expire, So that's why it's not quite equivalent, our stock options to investing. Oh, that's an interesting question. So I think a lot of AI is really going to increase that, because what it's going to enable is people to, first of all, more effectively teach themselves new skills, but also to automate a lot of the legwork of development, such that products that previously may have required 10 or 15 person teams now might be doable with 2 or 3 person teams, or maybe even one person, right? And so, if you're making a couple million in revenue on a 10 or 15 person team, that's not going to be very sustainable financially. But if you're making 2 or 3 million in revenue with a 2-person team, that's very sustainable financially, right? So some other trends. Well, one thing, from my perspective, obviously, I'm in early stage, and that's kind of what I'm looking at. So one thing I see in my world that I think is going to happen is, and we're already seeing this start, in my opinion, but in the next, say, 5 to 7 years, I think there's going to be a pretty dramatic change in what the infrastructure of early stage venture support looks like. So right now, you've got relatively clear lines between accelerator programs, venture capital, angel investors, incubators, venture studios, whatever. Already around the incubator, venture studio, accelerator model, we're starting to see a lot of blurring, with a lot of capital flowing into later stage VC. What we've seen is kind of the smaller funds sort of being forced upstream, to the point where now, you've got institutional capital, VC funds, as opposed to angel investors, who are actually writing, first checks into even pre-product companies, super early stage, pre-seed or even earlier, right? 5, 6 years ago, that was borderline unheard of. You're getting angel investment from individuals at that stage. You're not looking at real capital until later. 10 plus years ago, you weren't getting institutional capital until Series A, and Series A rounds were way smaller, right? So you could make the argument that what was Series A is now just a seed round, and it's just the nomenclature that's changed. But I think it's indisputable that what we're seeing is more and more, we're seeing institutional capital moving up the value chain. So essentially what that means is, as a founder, you're getting VC money earlier and earlier. Combined with that, there's an increasing expectation, both from investors into the VC funds, as well as from the founders seeking investment from those VC funds. There's a growing expectation that VC fund is going to be providing a lot more value than just capital. And when you're looking at the very earliest stages, it's very difficult to reasonably assess the risk and the potential of a startup at that real, like, even pre-product, right? What are you going on? So a traditional due diligence process that could be really effective at, say, Series A, when you've got a couple of years or more of, financial data, revenue and costs and whatnot, you don't have any of that at pre-seed. So traditional due diligence process is not really that useful. So instead, what we're starting to see is a lot of those companies, a lot of those VC funds, I should say, creating either formalized accelerator programs or de facto accelerator programs. So this gives them the benefit of being able to provide a lot of additional support to their portfolio companies early on. Frequently, they'll use it as a way to create deal flow and assess risk before making an investment. So Antler VC has one of the most advanced and formalized structures I've seen along these lines. Loyal VC, that I work for as well, has a very similar process through their relationship with Founder Institute. But essentially, the idea is getting insight into how a founder is approaching challenges and thinking through their company at the earliest stage over a period of time, right? From kind of an insider's view, as opposed to just a due diligence process, and then making an investment decision after seeing the benefit of that, right? So I think more and more what we're going to see over the next few years is just this blending of these different models. I think the idea of a strict VC fund, at least pre-Series A, is on its way out. I really strongly suspect. Not to say that there won't continue to be just VC funds, but I think increasingly the standard model, the default, is going to be something that's blending a lot of non-financial support with the investment in something a little bit more like maybe even something approaching a venture studio